Hello everyone and welcome back. In today's class, we're going to look at the main sources of differences between the gross return and the NAV-based return. The class will be divided into two sections. In overview, we will look at the gross and the NAV-based return, and in the second section, we will look at the main source of the differences. So let's start. The gross return is the fund performance calculated by the investment management firm. It's the return that doesn't include any fees except those included in the trade, the buy, the sales. On the other hand, the NAV-based return is derived from the net asset value, the NAV, which is a fair valuation of the fund calculated by the custodian and divided by the outstanding number of units. Depending on the type of fund you are dealing with, it can be calculated on a daily, monthly, or even quarterly basis. The NAV-based return is the variation of that NAV plus any distribution over a stated period divided by the previous NAV, as indicated in the below formula. The NAV-based return is the net return because it includes the fund expenses and fees. Those fees are classified as operation fees or management fees. In a perfect world, therefore, the differences between the gross return and the NAV-based return should be the fees, but that's not always the case. And we're going to see why by going through the main element that could cause that will explain the extra differences not explained by the fees, so that you're able to answer questions coming from the portfolio manager, member of the marketing team or client service team, and any other business partner that you may have. So the first element that could explain the differences are the holdings. You have to make sure that both the portfolio management fees, the portfolio management firm, and the custodian have the same quantity of the security on each side. Every transaction, whether it's a buy or sell or corporate action, has to be reflected by both of them. Otherwise, the quantity will not be the same, the valuation will not be the same, and therefore the performance will be off. Second element that could explain the differences are the price. We have to make sure that the price of each security is the same on both sides. If, for example, IBM price is $45 at the end for June 2017, both sides should reflect that price. The only security that could have a different price between the two sides are the bonds or any illiquid securities. Bonds, because of their complexity, we see the price vary depending on how brokers and product provider value them. If the investment firm and the custodian don't have the same provider, their valuation could be different and cause the gap. The same goes for liquid security that can have both sides use different method of valuation. The next element that could explain the gap are the exchange rates. You have to check if the exchange rate used is the same on both sides. If, for example, you have a fund with a base currency in US dollar that invests in foreign security, for example, Canadian stock, if one side use the London 4 p.m. exchange rate, whereas the other one use another source for the exchange rate, the valuation of those security will be different. The portfolio total value will be different, and so will be the performance. The next element that could explain the differences is the treatment of cash flow. Both sides should treat cash flow the same way. If, for example, one side decides to treat the cash flow as an income and the other side as a cash deposit, the total return will be different and one return will be higher than the other one. So we have to make sure that cash flow are being treated the same way on both sides. The other element is the provision for performance fees. Let's consider a fund which NAV is calculated on a monthly basis and that pays performance fees once a year. Those fees are usually high and reduce the NAV of the fund. Applying them just once will greatly reduce the NAV and also its derived return. To avoid that, an accounting entry provision for performance fees will instead be calculated every month. An increase in that entry will reduce the NAV since it's a fee and vice versa. This way, the impact on the NAV will be lower because the performance fees are smoothed over time. In an ideal world, the NAV will keep on increasing and so will the performance fee to be paid. However, the NAV movement will much resemble the shape of a roller coaster, and during the down period, the NAV might decrease even below the level required for performance fee to be paid. When this happens, the provision for performance fee will decrease and sometimes even reach zero. That will translate into a gain, causing the current NAV to be much higher than the previous NAV. Since the provision of performance fee is an accounting entry on the custodial side for the NAV valuation, the gain generated will not be included in the calculation of the gross return by the investment management firm. When this happens, the NAV-based return calculated might be higher than the gross return. So that's it. These are the elements. I hope this was helpful, and I will see you in the next class. Have a good day. Thank you.